That steak at the grocery store, the rate on your mortgage, the interest you're earning in your savings account. What if I told you that the cost of all of it is being quietly manipulated by four powerful levers, and the people who control them, they aren't elected officials you vote for. They're part of a small, influential committee that operates under a name that sounds official and maybe a little boring: the Federal Reserve. But there is nothing boring about the power they wield. Their decisions quietly dictate your entire financial life. It's the invisible hand that makes getting a mortgage feel like a breeze one year and crushingly expensive the next. It's why your savings account might suddenly start paying you a decent return after years of earning pocket change. It's the force that can make the stock market feel like a rocket ship or a roller coaster. Most of us feel like we're just passengers in an economy we don't understand, tossed around by booms and busts that feel random. But they're not random. They are, in large part, the result of deliberate actions. By the end of this, you'll understand exactly what these four levers are. You'll get the playbook, and you'll never look at your money the same way again. So, what exactly is the Federal Reserve? Established back in 1913, the Fed is the central bank of the United States. Think of it as the government's bank and the banker's bank. But its most critical job is to manage the U.S. economy. It has what's called a dual mandate: to promote maximum employment and to keep prices stable. In other words, its job is to help make sure people have jobs and to stop inflation from spiraling out of control. It's a delicate balancing act. If the economy runs too cold, people lose their jobs. If it runs too hot, the cost of everything explodes. The Fed's job is to act like a thermostat, constantly tweaking the economic temperature to keep it just right. But how? It doesn't pass laws like Congress. Instead, it uses a unique set of tools, its monetary policy, to influence the flow of money and credit through the entire country. These are the levers. For decades, these tools were buried under a mountain of complex financial jargon, understood by economists, but totally opaque to the rest of us. But that ends today. We're pulling back the curtain to reveal the four primary levers the Federal Reserve uses to control the economy and, by extension, your financial world. We'll break down what they are, how they work in simple terms, and how their movements are shaping your life every single day. Let's start with the one they use most often. The first and most important lever is the federal funds rate. If the economy were a car, this rate is both the gas pedal and the brake. It's the tool the Fed uses most frequently to either speed up or slow down the whole show. So what is it? The federal funds rate is the interest rate that banks charge each other to borrow money overnight. See, banks have to keep a certain amount of cash on hand. If one bank is a little short at the end of the day, it'll borrow from another bank that has some extra. The interest on that 24-hour loan is the federal funds rate. Now, the Fed doesn't just declare this rate. It sets a target range, for example, between 3.50% and 3.75%, and then uses open market operations, OMOs, to nudge the actual rate into that sweet spot. Here's a simple way to think about it. Imagine the banking system is a giant bathtub filled with money. When the Fed wants to lower interest rates, it uses OMOs to buy government bonds from big banks. The Fed pays for these bonds by digitally dumping cash into the bank's accounts. Suddenly, the banks are flush with money. The water level in the tub rises. With so much extra cash sloshing around, banks don't have to charge each other as much for those overnight loans. The federal funds rate falls, and borrowing gets cheaper for everyone. When the Fed wants to raise interest rates, it does the opposite. It sells bonds back to the banks, and the money flows out of their accounts and back to the Fed. The water level in the tub goes down. With less money available, banks charge each other more, and the federal funds rate rises. To keep the rate from going too high or too low, the Fed uses two guardrails. The interest on reserve balances, IORB, is the rate the Fed pays banks on the cash they keep with the Fed. This acts as a floor. No bank will lend to another bank for less than it can earn risk-free from the Fed. The overnight reverse repo facility, ONRRP, acts as a similar floor for an even broader group of financial firms. How does this affect you? This is where it gets personal. The federal funds rate is the foundation for almost all other interest rates. When the Fed hikes its target, banks pass that cost on to you. Your credit card's variable interest rate climbs. A new car loan gets more expensive. And most importantly, mortgage rates go up, making it harder to buy a house. The goal is to make borrowing less attractive, slow down spending, and cool off inflation. We saw this happen aggressively starting in 2022 as the Fed fought the highest inflation in 40 years. Conversely, when the Fed cuts rates, borrowing gets cheaper. Credit card APRs may dip, and lower mortgage rates encourage home buying and business investment. As a recent example, the Fed cut its target range to 3.50% to 3.75% on December 10, 2025, to help support the job market as inflation fears eased. In that move, it set the IORB rate to 3.65% to guide the market. This single lever is the Fed's daily driver for steering the massive ship of the U.S. economy. The second lever is one you don't hear about every day, but it's a core reason the Fed exists. It's called the discount window, and it's the ultimate emergency backstop for banks. It's the Fed acting as the lender of last resort. The discount rate is what the Fed charges banks to borrow money directly from the Fed itself. This is different from the federal funds rate, where banks are lending to each other. Imagine the banking system as a network of high wire walkers. Most of the time, they're balanced and can support each other. If one stumbles, needs cash, it grabs onto another for a quick loan. But what happens if a financial panic hits and all the banks are stumbling? What if no one is willing to lend because they're all scared? This is when the discount window opens. A bank that can't get cash from other banks can go straight to the Fed for an emergency loan. This prevents a liquidity crisis where a healthy bank could fail just because it can't access short-term cash. This is what stops the kind of bank runs that plagued the country before the Fed was created. There's a catch though. The Fed intentionally sets the discount rate higher than the federal funds rate. For instance, in December 2025, the discount rate was set at 3.75%, the very top of the federal funds target range. This encourages banks to borrow from each other first. Borrowing from the discount window carries a stigma. It can be seen as a sign a bank is in trouble, making other banks even more hesitant to lend to it. How does this affect you? Unlike the federal funds rate, this lever doesn't directly change the interest rate on your car loan. Its effect is more foundational. You don't feel it when it's working, but you definitely feel it if it were gone. By providing a guaranteed source of emergency cash, the discount window ensures the stability of the very bank where you keep your money. It prevents one bank's problem from turning into a full-blown financial meltdown, like what we saw during the 2008 crisis, when borrowing from the discount window skyrocketed to keep the system from freezing solid. This lever is the quiet promise that the financial system has a safety net. The third lever is one of the Fed's oldest tools. It's called the reserve requirement. Think of it as the rule book dictating how much of your money a bank can and cannot lend out. The idea is simple. For every dollar in deposits, the Fed used to require banks to hold a certain percentage in reserve, either in their vault or at the Fed. This money couldn't be loaned out. If the requirement was 10%, a bank had to keep 10 cents of every dollar on hand and could lend out the other 90 cents. This was a very blunt tool. If the Fed wanted to slam the brakes on the economy, it could raise the requirement to 20%. Instantly, every bank would have to pull back on lending. Lowering it would free up cash and juice the economy. But here's where the story gets interesting. On March 26, 2020, to fight the economic crisis from the pandemic, the Fed did something huge. It cut the reserve requirement to 0%. That's right. As of today, the reserve requirement is 0. That rule in the book has been erased. Why does a 0% lever matter? So if it's set to 0, this lever is useless, right? Not at all. The move to 0 is one of the most significant shifts in modern banking. It shows how the Fed's power has evolved. By setting the requirement to 0, the Fed abandoned its old, clumsy method. Instead of forcing banks to hold money, it now entices them using interest rates, like the IORB rate we talked about earlier. It's a shift from a command and control system to a flexible, incentive-based one. But here's the key. The power to impose reserve requirements is still on the books. The Fed has simply chosen to set the number to 0. This forgotten lever represents a massive amount of power held in reserve. If a future crisis demanded it, the Fed could flip that switch back on, sending a shockwave through the banking system. Understanding this lever means understanding the full scope of the Fed's authority. Our fourth and final lever is the newest, most powerful, and by far the most controversial. It's a policy with a technical name, quantitative easing, or QE, but you can think of it as the break glass in case of emergency money printer. QE is what the Fed uses when the federal funds rate is already near zero and the economy still needs a massive jolt, as it did after the 2008 financial crisis and during the 2020 pandemic. So what is QE? Remember open market operations where the Fed buys short-term bonds? QE is that same idea, but on a mind-boggling scale. With QE, the Fed electronically creates trillions of new dollars to buy huge quantities of long-term government bonds and other assets like mortgage-backed securities. This isn't just turning on a faucet, it's summoning a tidal wave. The goal is twofold: to crush long-term interest rates. By buying up so many long-term bonds, the Fed drives their prices up and their yields, interest rates, down. This directly lowers costs for things like 30-year mortgages. To force money into riskier assets. When the Fed buys safe bonds from investors, those sellers are suddenly sitting on a pile of cash. Since safe bonds now pay less, investors are pushed to buy other things, like stocks. This drives up the stock market and creates a wealth effect that hopefully boosts spending. Of course, the opposite of QE is quantitative tightening, or QT. That's when the Fed shrinks its massive portfolio by letting bonds mature without replacing them, pulling money out of the system. After a massive QE program, the Fed started QT in 2022 to fight inflation. More recently, in December 2025, the Fed announced a major policy shift, ending its aggressive balance sheet reduction and starting to buy some treasury bills again to ensure markets run smoothly. How does this affect you? This lever has arguably had the most dramatic impact on your wealth over the past 15 years. If you own a home or have a 401k, you've likely been a major beneficiary of QE. The stock market's incredible run from 2009 to 2021 was heavily fueled by the trillions the Fed pumped into the system. The record low mortgage rates were a direct result of QE, but it has a dark side. QE has been accused of fueling wealth inequality, as those who owned assets saw their net worth explode while others were left behind. And now that the Fed has shifted its stance on QT, we're all feeling the effects of these powerful and often unpredictable decisions. This fourth lever is the Fed's bazooka, and it has long-lasting consequences for everyone. So there you have it. The four levers the Fed uses to shape our economy. First, the federal funds rate, the daily gas pedal and brake for borrowing costs. Second, the discount window, the emergency backstop keeping our banks stable. Third, the reserve requirement, the forgotten rule book that, even at zero, holds immense power. And finally, quantitative easing, the break glass money printer that can reshape markets in a crisis. These aren't just abstract theories. They are active decisions that directly impact your mortgage, your credit card rates, your savings, and the value of your 401k. By understanding this playbook, you can stop feeling like a passenger and start seeing the road ahead. When you hear about rate hikes or QT, you'll understand the real-world impact on your wallet. This knowledge empowers you to make smarter decisions to protect and grow your own wealth. Now that you know the four levers, I have a question for you. Which of these tools do you think poses the biggest risk to our economy today? Is it the blunt force of interest rate hikes or the unpredictable consequences of QE? Let me know your thoughts in the comments below.